What if I said that you've never been told the truth about Wall Street, or how Main Street isn't even on the same financial map? Picture this: million-dollar paychecks, rubbing shoulders with some of the most bold and brilliant minds in America, indulging in world-class restaurants and sipping cocktails late into the night, only to rise at 5 a.m. for another day in the scrum. You see, once you're deep inside the Wall Street machine, there's a magnetic draw that makes leaving seem completely absurd. You'd have to be an idiot to do it. Well, I was one of those idiots who chose to walk away. In 2018, I took a different path, and here I am today running one of the largest finance-related channels on YouTube. Back then, I was a young director at a top-tier bulge bracket investment bank. My job? I built a fixed income arbitrage business from the ground up, managing billions in trades, with a B. All with a few mouse clicks and a stack of spreadsheets as high as the Eiffel Tower. And maybe that's why I'm one of the few people who can expose how the game really works. Or doesn't, depending on who you are. But why haven't you been told the truth in the first place? Because there's no one to do it. The already small group of Wall Streeters aren't exactly marching over to YouTube after they leave. They're at the next fund or the next bank. Insiders aren't going to make a peep when their paycheck depends on it. But today I want to expose a big secret to hopefully save you a lot of pain and suffering. Namely, there are two distinct worlds in finance: Wall Street and Main Street. And if you're like most people, and please don't take this the wrong way, you're likely familiar with a sanitized and simplified version of how money really works. Only about 10,000 people are genuinely on the inside. So statistically speaking, that's probably not you, but I'm here to give you the scoop. In essence, the world of finance is split into two huge chunks: institutional finance, that's Wall Street, and retail finance, that's Main Street. Think of it as Gordon Gekko versus mom and pop. Hollywood only glamorizes institutional finance. Corporate raiders, colossal hedge fund traders, and bankers orchestrating mega mergers. Heck of a game. And from this vantage point, it looks quite thrilling, as it did to me when I was a young, aspiring trader. But that has very little to do with the retail investor experience. In fact, I think institutional finance does serve an important purpose. This is the machinery of the economy. Businesses facing businesses with huge sums of money, complexity, and trust. In fact, without institutional finance, the economy wouldn't really run. But speculative retail finance? This is never something that ends well for the general public. Pick your favorite stock market crash. And today, I still don't get it. And the math doesn't math either. Even the stock market itself is designed to offload corporate risk on someone else. That's you. So back on Main Street, the game you're allowed to play is akin to a preschool version of the real thing. It's like a game of Monopoly around the kitchen table rather than with a team of developers and $1 billion check. The truth is that retail finance is sculpted by Wall Street, just like how casinos are designed by hotel and entertainment companies to make you feel like you're having a good time while they gradually take your money. And this isn't my hot take, this is an actual fact. What's at play here is the illusion of control. With just a smartphone, you can trade and manage funds feeling like a financial wizard. Yet you're merely playing in someone else's sandbox where the advantage is never in your favor, and the more you play, the more you stand to lose. You've heard the phrase, the house always wins. And Wall Street is no different. But I want to show you what you can do about it. I'd like to take a minute to thank the sponsor of our video, ReviseAnnuity.com, which is my company, so I really hope you check it out. At ReviseAnnuity.com, you can explore expertly designed annuity strategies and find the right one for you in minutes. No need to hop on a boring call with an advisor or face high-pressure sales tactics. Everything is transparent for you to explore and customize. Annuities offer the upside of the market without any of the downside, so it's worth checking it out. To learn more, head to ReviseAnnuity.com. All right, back to the show. Here's what you'll discover in this video. Number 1, understand the true reasons behind the push for self-managed finance and why it's a trap. Number 2, uncover the stark contrasts between these two worlds and how retail investors are often placed at a disadvantage. Number 3, learn why trading your own money typically leads to underperformance. Number 4, discover why discretionary fund managers often fail to outperform the market themselves. Number 5, learn why long-term success lies in passive investment strategies and why your financial advisor might not be as savvy as you think. Number 6, learn how to spread and adjust your risk especially as you age, to protect your wealth. Number 7, learn why you should steer clear of financial news and why this is essentially just advertising for the biggest casino on earth. And number 8, and most importantly, we're going to dive into 3 proven strategies that you can use today. These are things that actually work to keep more of the returns in your pocket and less out of the Wall Street coffers. So why are you trying to manage your money in the first place? Actively managing your own finances might seem empowering, and if you're a guy like me, it may even seem manly or gentlemanly. But let's uncover the real reason behind the push for self-managed finances and why it could be a trap. The financial industry sells the idea that with the right tools and knowledge, anyone can be their own investment manager. And why would they sell that story? That's because the self-managed portfolio is the most lucrative kind for big banks. They want you to think you know what you're doing, so you trade more. However, research from Dalbar highlights that the average equity mutual fund investor, aka the average 401k or retirement account, underperformed the S&P 500 by 4.13% annually over a 20-year period through 2019. And why? Emotional decision-making, lack of expertise, and transaction costs all contribute to this underperformance. You see, the system is designed to keep you engaged, much like a video game, but with real money at stake. So for this first section, I need you to ask yourself one question. Do you actually want to build wealth, or are you just here to have fun? Now let's break down the stark contrast between institutional and retail finance. Institutional finance is the realm of Wall Street, exclusive, fast-paced, and immensely powerful. In institutional finance, well, the word institution is the most important word. It's transactions between large corporations and other financial institutions. Take BlackRock for an example, managing over $9 trillion in assets. They have access to sophisticated algorithms, immense leverage, and proprietary insights. On the other hand, retail investors often face higher fees and less favorable trading conditions. In institutional trading, the banks can win, their big customers can win, like hedge funds and mutual funds, but who's picking up the tab? Well, that's you. A 2018 study by Morningstar found that the average equity fund investor paid an expense ratio of 62 basis points compared to 27 basis points for institutional investors. That's more than double. Essentially, Wall Street creates the rules of the game and benefits from the masses playing it on Main Street. So now that you know it, does this game seem as fun? Trading might seem like an exciting way to grow your wealth, but let's explore why trading your own money typically leads to underperformance. Unlike institutional traders who have access to vast resources such as Goldman Sachs' trading desk, of which I know a handful of the traders, retail traders operate with significant disadvantages. According to a study by the University of California at Berkeley, accounts held by individual investors underperform the market by about 1.5% to 2.5% annually. The culprit? Emotional decision-making, lack of timely information, and higher transaction costs. Sound familiar? The truth is, unless you're using someone else's capital and resources, aka you're already a professional trader, your chances of consistently outperforming the market are slim. Now, if you know you're going to lose, why bother playing the game in the first place? Many people believe that discretionary fund managers are the answer to their financial woes, and I can't blame them. Investing is hard. However, let's discover why these managers often fail to outperform the market they try to beat. According to S&P, over a 20-year period ending in 2020, about 90% of actively managed U.S. equity funds outperform their benchmarks. That's 9 out of 10 guys failing the class. High management fees and frequent trading are among the reasons why. In reality, you might be better off investing in a low-cost index fund rather than paying a hefty fee to a manager who statistically is likely going to under-deliver. What's the opposite of active management and trading? Passive investing. Why is passive investing considered the golden path to long-term financial success? Unlike active trading, passive investing focuses on buying and holding a diversified portfolio with low turnover and minimal fees. This approach aligns with the overall growth of the market and reduces the risk of making poor timing decisions. Vanguard reported that over a 10-year period ending in 2019, 82% of their passive funds outperformed their active fund peers. Now, some financial advisors, and there's good ones and there's bad ones, may not emphasize this because they benefit from the fees and commissions tied to more complex, actively managed strategies. You can't blame them for doing their job. But sometimes you need to ask yourself, am I underperforming or outperforming the market? Spreading and adjusting risk is crucial, especially as you age. Diversification, I'm sure you've heard it before, is your best friend here. That's holding a mix of asset classes such as stocks, bonds, and real estate. This reduces the impact of any single investment's poor performance. And as you near retirement, shifting a portion of your portfolio from equity to something safer like bonds or annuities can help preserve your capital. Research shows that a diversified portfolio that's holding a lot of different uncorrelated assets can potentially provide a more stable rate of return than a single investment in one asset class. So looking through your portfolio, you might want to ask yourself, am I too consolidated in any one sector or asset class? If you are, at the end of the video, I'll tell you what to do about it. Financial news might seem informative, but let's understand why you should steer clear of it. It's advertising for the largest casino on earth. Financial networks thrive on sensationalism and urgency, which can drive impulsive decision-making and market panic. A study from the University of California at Riverside found that high media coverage of stocks increases investors' trading volume and volatility, often leading to worse outcomes. The more you trade, the more you lose. Instead of consuming news that encourages short-term thinking, turn it off and stick to your plan. All right, the moment we've been waiting for, let's dive into the 3 investment strategies that will actually work for you. And they're easy. I'm gonna list them in order of how much money you have to work with. Hard assets. Okay, my really rich friends, you've got the cash. Investing in real estate and land can provide stable long-term returns and serve as a hedge against inflation. For instance, between 94 and 2019, commercial real estate as measured by NCREF provided an annualized return of 9.1%, outpacing even the S&P 500's 8.6% return over the same period. Property values tend to appreciate over time, and you can generate additional income through rent. Moreover, real estate investments often benefit from tax advantages such as depreciation and the 1031 exchange. A 1031 exchange is rolling the proceeds from the sale of one property directly into another without having to pay tax on the appreciation. Fixed indexed annuities. It's no secret that I love annuities, and that's why I started Revise Annuity, but annuities are a superb tool for the wealthy and the folks in the middle alike. Low-fee fixed indexed annuities can be an excellent tool for long-term investing. They offer a blend of safety with upside potential, and you can adjust the index inside your annuity as you age, which helps manage risk and protect against negative market trends. You can choose from a handful of different indices and even express sector ideas by tying your annuity to real estate or a commodities index. They're an especially good inflation hedge and weather volatility. This can provide investors with peace of mind knowing that their principal is protected while still having growth potential. And most importantly, an annuity is something that you don't actively manage, so you won't subject yourself to the same timing risk that comes with trading. For more information about annuities, check out my company, reviseannuity.com. What about low-cost ETFs? These are an excellent option for those just starting out. And that's because you can buy them in tiny slices. That's a lot more difficult with hard assets or an annuity. Leveraging ETFs allows you to build a diversified, cost-effective portfolio. ETFs cover a wide range of asset classes and sectors, giving you broad market exposure with low management fees and high liquidity. For example, the Vanguard Total Stock Market ETF offers exposure to the entire US stock market at an expense ratio of just 3 basis points. This low cost can significantly improve returns over the long term. As you know, high fees erode gains. So no matter where you are in your career, there is a passive strategy for you, whether it's hard assets, fixed index annuities, or ETFs. That's because smart investing isn't about playing the Wall Street game on their terms. It's about making informed strategic decisions that align with your long-term goals. And this many times means not playing the active management game at all. If you found this video helpful, make sure to like, subscribe, hit the notification bell so you don't miss any of our future updates. Leave a comment below with your thoughts or questions. We'd love to hear from you. Check out our sponsor at reviseannuity.com, and until next time, stay really rich.